The US Federal Reserve has increased interest rates by 0.25 percentage points. The interest rate now in the US is at a 16-year high, moving from 5% to 5.25%. The decision was unanimous by the Federal Open Market Committee. The expected rate rise was the 10th increase in just over a year. And for more on this, let's bring in AMP Capital Chief Economist Shane Oliver. Good to see you, Shane. So the Federal Reserve raising rates again, now at a 16-year high. What impact, if any, is this causing?
Well, obviously, it's another monetary tightening in the US, which tightens the screws further on the US economy and increases the risk of US recession. But I think what was significant was that the Fed toned down its hawkishness. It removed a reference to its expectation that further monetary tightening would be appropriate and adopted more open language, somewhat reminiscent of some people have said what they used back in 2006 when they last stopped raising interest rates ahead of the GFC. So there are some signs that they've reached the top. I think they probably have reached the top, so that's good news. But obviously, the door is still open to further hikes, and that's why the US share market sort of came down at the end of trading overnight.
Yeah, the banking sector has been shaky of late in the US. Is this fueling further speculation of a recession?
It certainly is. I think there's often an inclination with these things. You see the first tremor, obviously, that Silicon Valley Bank almost 2 months ago now, early March, and then it sort of comes under control. There was one more bank after that got into trouble. Then there's this sort of confidence crept in that maybe it's been contained. But quite clearly the issue is still there, because earlier this week we saw First Republic, another US bank, seized by US authorities and then ultimately sold on to JP Morgan. So in a sense, they're mopping up the issues with individual banks, but there's still issues with other banks. Shareholders worry that if the same thing happens to them, they'll have their shareholding wiped out. And of course, those banks, those smaller banks in the US, and there's lots of them, are now a lot more cautious in their lending, which is a de facto monetary tightening, because they don't want to go the same way as these other banks that have been seized and then sold on to someone else. So that tightening is still there. I reckon it's the equivalent of at least a couple of interest rate hikes by the Fed. And obviously, it will bear down, particularly on small and medium-sized businesses in the US, and that adds to the risk of a US recession.
And you said that the US might be at the top of their rate hiking cycle. Could we follow a similar path?
Well, I'm hopeful on that front. I've been a bit too optimistic on that front lately. Rates have gone a lot higher here than I would have thought justified. But I do think if the US is getting close to the top, and don't forget the US inflation surge led the surge in inflation in Australia by about 6 months, then there's good reasons to believe that we're getting close to the top as well, if not already being there. So I think it would be a good sign if the Fed has reached the top. And it is noteworthy, there's a lot in their statement today and the comments from Powell that suggest they may be getting there, they may be there, and that going forward there'll be a lot more data dependent. So I'm pretty hopeful on that front, but obviously the risk for share markets will sort of start to shift away from worrying about inflation and interest rates to worrying, I think, more about the risk of slower economic growth and the risk of recession. I think we can avoid a recession, but it's obviously a close call.
Okay. Good to talk to you, Shane. Thanks so much. Shane Oliver there.